right, everybody. Welcome back to the Small Axe Podcast, your hub, your spot to get the best up to date multifamily stuff that's going down in the world today. Whether you are a brand new investor, a seasoned investor, somebody who's just looking to learn, or somebody who's looking to grow, expand, this podcast is for you. Today, I want to talk about something that a lot of operators are quietly experiencing right now. Deals just don't pencil. And in reality, they've never really penciled. So, our job today is trying to figure out what is making them not pencil today. During different market cycles, deals don't pencil for different reasons. I personally feel like deals never pencil, and that's because the sellers are always trying to get the top dollar, which makes sense. So they don't pencil. But what is causing deals to not pencil today is what really drives me to dive deeper and figure out a little bit more about what's going on behind the scenes. People are underwriting deals and saying, just what the heck happened? I was able to pay 120 a door 3 years ago, 4 years ago. Now I can't. I can only pay 90 a door. Why doesn't this work anymore? What's happening? What's going down? And the answer is kind of easy. Two big things changed. Debt obviously changed. Underwriting changed. Us as operators, we just have to figure out how to underwrite it properly for our standards to ensure that we get the best deal possible. So, in other words, deals will never actually pencil to a seller's expectation in any market condition because sellers look for top dollar, which is normal. We, as potential buyers, need to understand how to underwrite during different market conditions. So if you're still using the 2021 playbook, you are going to get confused in today's market. All right, so banks today are pulling back. Let's start with this. Lending. Banks are lending right now, and deals are getting done, but the rules are just different. What I'm seeing across the board today is lower leverage, maybe 55, maybe 60 LTV, higher debt service coverage ratio requirements, more scrutiny on buyers, the KPs, the person or people signing on the loans, more reserves required at closing. So 5 years ago, you could get a 75 to 80% LTV on a multifamily deal with many different lenders. Today, a lot of those deals are really closer to 60, maybe 65%, even 55% if you want to play it safe. But some lenders are willing to go to 65% leverage, depending on obviously the lender and the deal profile and you, the potential buyer. And the changes today in lending mean that you need to have a lot more equity to get deals done. When you put down more equity, the deal is typically safer, but returns are worse. If you have to come out of pocket with more money, the returns are going to be worse. But it's a risk mitigation strategy that a lot of people like to use anyway, even during flourishing times. Today's a depressed market for sure, which means we should be buying. But again, lending is tight, and we have to understand how a lender will look at your deal and look at you. They're going to underwrite the deal, and they're going to underwrite you and or your team. So banks are being more conservative because they got burned on some deals that were done during the low rate environment. Interest rates jumped, operating expenses jumped, and regulators are leaning on banks to tighten up risk. So even though multifamily is still one of the strongest asset classes, banks are protecting their balance sheets as they should. About 7% of multifamily CMBS loans are currently delinquent. That's up from about 4 or 5% a year ago, mostly from floating rate bridge debt coming due. So banks have to be careful. If delinquency is up, they're going to have to be more strict about who they lend to and what products they lend out. Now, let's talk about the second piece of the puzzle. Why do the deals that worked in 2021 fall apart today? There are three big reasons, in my opinion. First, debt costs. Back then, you could borrow money at 3%. Yeah, it was possible. It's basically free, sometimes even lower than 3%. I have friends that have under 3% loans. Today, you're looking at something closer to 6 or 7%, depending on the deal, and that changes your math instantly. So your underwriting is completely different with a 7% loan than it would be with a 3% loan. You got to know that. When your debt service goes up, the DSCR gets tighter and the proceeds shrink. So banks are not going to give you enough money because you're not going to hit that debt service coverage ratio. You're not going to be able to cover the debt if they loan too much on the property. Number two, expenses have reset as well. A lot of expenses across multifamily have jumped over the past few years. Labor, materials, taxes, utilities, insurance is a great example of this as well. When I bought my first property in 2022, we were paying $750 a door per year for insurance. Literally 4 months after closing, or less than that, less than 4 months after closing, it jumped from $750 a door to $1350 a door, essentially doubling. Today, we're back under $1,000 a door, but it is still inflated, still causing issues. The insurance spike is real. So yeah, I'm finally seeing the market stabilize a bit in some areas for insurance, but here's another thing that we need to watch out for. Properties are getting older. So that 60s and 70s or maybe even 80s vintage product that you were looking at before and was more easily insured before might cost you more today because components are starting to fail. Remember, there's only 30 years on a roof. And today, even if you bought a 1990s product, your roof might need to be replaced. So properties are aging and insurance is going to note this and take care and take caution. There's also a lot of failing circuit breakers out there and different types of panels that you need to be aware of as well, like Federal Pacific, Zinsco panels that are failing and are just going to have to be replaced. So insurance companies really look out for that kind of stuff. Operators, us, we have to underwrite things carefully and understand that expenses are not going down. So when you're underwriting a deal, understand that if you're getting the actuals, your expenses are likely going to go up a little bit from the actuals. You are not going to be this Superman, Superwoman operator that's going to go in there and reduce expenses. Expenses are either going to stay the same or more than likely go up. So when you're underwriting, you have to have an expense escalator. I typically do 3%. And on the flip side of that, your rent is probably not going to be 3% increase. Mine is zero. Mine is flat for the next year or two. We cannot get rent increases. And as a matter of fact, we are decreasing rents just to get occupancy today. The point is this, guys, you got to understand expenses are going up and you cannot just plug in those old numbers from 2021 because times have changed. And this leads me to the third point. As I was saying before, CapEx is going to be a huge issue. Insurance is going to look at the CapEx issues, and you are going to be left with this CapEx tsunami when you take over a property that is 60s, 70s, 80s, or even 90s product. Roofs need to be replaced. HVAC systems, electrical panels, plumbing, drainage, parking lots, landscaping, guys, it all adds up. So when I'm looking at deals today, I often start with something around $10,000 per door in CapEx just as a baseline, even before I begin my underwriting. Maybe it ends up a little bit lower, but most likely not. It usually ends up higher. And you have to start with realistic assumptions. And another huge factor that many, many operators miss is to plan 3 to 5 years for your exit and how much CapEx you need on hand for that exit. Because typically you want to show proof of concept for the next buyer of what can be done on the property. And at the very least, you're going to have unit turns, which could be anywhere from 1,500 to 3,000 a door. And you might turn half the units a year. So you have to consider that. But on the other side of that, we have CapEx, where you want to actually renovate a unit to get a rent premium. Today, it might not be worth renovating to get a rent premium. But in the future, as things are degrading further and you have to renovate the property just to command a higher rental price, you have to have that money on hand. You are not going to pull $10,000 per door to renovate a unit, and it might even be more actually, 12 to 15,000, especially by then in the next 3 to 5 years. You're not going to pull that out of your operating income. It's not going to happen. Stop dreaming. Know that you have to have that money available today when you close on the property. You need a CapEx budget for exit. You want to estimate at least 5% of the units being completely renovated before sale so that you can position the product for a better sale price. So, what are smart operators doing today? Serious investors like me are not panicking. We are just adjusting. We adjust our underwriting to be quote unquote more conservative. That phrase, conservative underwriting, has been beaten to death, but we need to be even more conservative. And yes, that means you might have to look at more than 100 deals just to get one. Remember, I always say it's a race to 100. For every 100 deals you look at, you might get one, but today you might have to look at 150 because you're underwriting even more conservatively, okay? You have to raise more equity in today's environment. That is not easy because liquidity is dried up. Investors are scared to invest right now. It is very difficult to raise capital today, in my opinion. So, real operators are also going to be negotiating harder today on their purchase price because they know if you can buy it at a good basis, you will be in a lot better position come a few years from now when the market shifts or if times get even worse. You need to buy at a great basis. And this is why I've been saying that we are seeing the best buying opportunity that we have seen since the great financial crisis. It might be even in your lifetime, depending on how old you are. And not because the economy is perfect. As a matter of fact, it's because the economy is messed up. People are losing jobs. The economy is struggling. People got burned on multifamily investments. People spent too much and cannot get out of their debt. People are defaulting on loans. All of this is a perfect storm leading to expanding cap rates, meaning lower prices, which is a great buying opportunity for us. The competition has disappeared, guys. People are not looking to buy multifamily today. Isn't that a good thing? Don't you think that that's a good thing for us who are in this for life? We are not fix and flippers as multifamily investors. We capitalize on those opportunities, but that is not our business model. That is not our general thesis. We are in this for life. And if we are in this for life, if that is true, and you know that to be true about yourself, then today is the best buying opportunity. Lower price points, lower competition. I was bidding against 15 or 20 groups 3 years ago. Now, nobody is bidding on properties. I looked at one recent call for offers, and yeah, they got a few offers, but it's literally nothing compared to what I was looking at back in 2021. And that's when disciplined investors like me and you start to acquire deals. So if you're looking at deals today and you think that they just don't pencil the way they used to, you're not crazy. You're actually right. Deals will never pencil because sellers are always going to try to get the highest sale price, which makes sense. But you just have to change your underwriting. The lending environment changed, the lending criteria changed, expense structure changed. Underwriting gets a little bit more tight, a little bit more serious, a little bit less lofty on the income growth, and a little bit more lofty on the expense growth. Operators who adjust to today's environment are the ones that are going to win big over the next market cycle, guys. I promise. Market cycles are real because real estate has always rewarded the people who understand the market faster than everybody else. They can see the patterns, they can see the ups and downs. You're never going to time it perfectly. You're never going to hit the exact bottom. You're never going to hit the exact top. But you see the pattern, you see what's happening, and you take advantage of it. And remember, guys, reading about deals does not make you an investor. Buying buildings does. Just be really careful about what you're buying. Go out there, make some offers. Hit me up if you want to join my cohort, the multifamily machine. Tonight is the first call for my second cohort. It is going to be epic. If you want a spot, you could either get in this one today or join my next cohort in 8 weeks from now. Love you guys.